All right, let's jump right into this explainer and unpack the legal armor that protects your biggest assets. We're talking about the really strict rules rooted in the Indian Stamp Act of 1899. If you've ever dealt with real estate, you've definitely heard the term stamp duty. But listen, it is far more than just some annoying line item on your final bill. It's literally the absolute bedrock of property law.
Here is our roadmap for today. We're looking at why you need stamp duty, the exact documents that require it, how to calculate your costs, what factors might change your rate, and finally, payment methods and timelines.
All right, part one, why you actually need stamp duty.
Picture this. You've just handed over exactly 1 crore rupees for a gorgeous new house. You've got the keys in your hand, you're moving the couch in, but wait. In the eyes of the government, that house isn't actually yours yet. It sounds crazy, right? Well, take a look at this journey. Person A sells to person B. You pay the money, that's step 1. Step 2, you draw up and sign the sale deed. But step 3 is the absolute linchpin. You have to pay the state government's stamp duty and registration charges. It's only after you clear that hurdle and register at the sub-registrar office that you hit step 4, where your ownership is finally, legally recognized.
So, why does this matter? Paying this tax isn't just mindless bureaucracy. You're essentially buying an ironclad shield to protect yourself against future ownership disputes. No stamp, no valid transfer. It's that simple. Registration gives you unquestionable legal proof of ownership. It's court-ready evidence if anyone ever tries to challenge you. It guarantees you can easily get duplicate copies if your dog eats the original, and it officially puts you on the government's permanent record.
Moving right along to Section 2, the exact documents that require registration.
Now, you might think stamp duty is just for buying a house outright, right? Well, yes, that's the big one. First up is the sale deed. Whenever money changes hands for a property, this is your foundational document, and registering it is strictly compulsory.
But what if no money changes hands at all? Say hello to the gift deed. Even if a very generous friend or family member gifts you that 1 crore rupee property completely for free, the government still steps in. You have to execute this deed, and yes, registration is absolutely compulsory. Free property definitely doesn't mean tax-free.
And hey, the exact same logic applies if you try to get a little creative with an exchange deed. You know, swapping your house for someone else's might feel like a simple, even trade, but it triggers the exact same legal tripwires. Both parties are transferring ownership, so the state still wants its cut.
What about keeping it all in the family? Well, if you're splitting up a jointly owned family estate, you'd use a partition deed. This locks in the newly divided boundaries for everyone involved, and, you guessed it, compulsory registration applies here too. The same goes for mortgage deeds when you're taking out a loan, and certain powers of attorney.
Now here is where things get really interesting. Check out this contrast for leases. If you're signing a lease for more than 12 months, registration is compulsory. But if it's 11 months or less, it's generally not compulsory. People usually just get it notarized. This is exactly why you constantly see 11-month rental agreements everywhere. It is a totally intentional workaround to avoid mandatory registration.
All right, on to Section 3, how to calculate your costs.
So you're probably wondering, what is this actually going to cost me? How much extra cash do you need to scrape together for that 1 crore house? Usually, stamp duty sits somewhere between 4 and 10% of the property value, plus about 1% on top of that for registration. But figuring out that underlying property value, that's where things get a bit tricky.
It basically comes down to a showdown between two competing numbers. In one corner, you have the market value. That's the actual real-world price you and the seller agreed on. In the other corner, you have the circle rate. This is the absolute minimum property value dictated by the state government. And just a quick aside, depending on where you live, they might call this the guideline value, the guidance value, or the ready reckoner rate. It's all the same thing.
Now here's the golden rule. You cannot cheat the system by officially claiming you sold a mansion for 10 rupees just to dodge taxes. The rule of thumb is that stamp duty is always calculated on whichever value is higher. The government is always going to protect their minimum baseline.
Let's put some real numbers to this. Say you agree to a market value of 1.5 crore, but the government circle rate is only 1 crore. The math is going to be based on your higher 1.5 crore figure. So if we assume a combined 5% rate for stamp duty and registration, you're looking at a pretty hefty tax bill of 7.5 lakh rupees.
But let's flip it around. Let's say you are a fantastic negotiator, and you snag a distressed property for only 70 lakhs. Incredible deal, right? Well, the government still looks at their own 1 crore circle rate. Because that 1 crore is higher than your 70 lakh purchase price, they calculate your tax based on the circle rate, meaning you still owe them 5 lakhs.
Which leads us to Section 4, the factors that actually change your rate.
You see, that 4 to 10% window we talked about isn't totally set in stone. State governments tweak your final bill based on a bunch of different factors. The state you're in is the biggest variable, obviously, since they set the base rates. But they also look at location. Rural areas often get a break compared to urban centers. Property type is huge. A residential home usually gets a lower rate than a commercial warehouse or a hotel. Even your age can get you a senior citizen discount. But honestly, one of the most interesting factors is the gender of the buyer.
Take a look at how places like Delhi use these tax rates as a literal tool for social change. A solo male buyer pays a 6% stamp duty. If you buy jointly, it drops to 5%. But if a woman buys the property alone, the rate drops all the way down to 4%. That's a massive, targeted discount designed specifically to empower and incentivize female property ownership. Pretty smart, right?
Finally, we hit Section 5, payment methods and timelines.
Here's the deal. You have to pay this duty on the exact date the deed is executed, literally the day you sign it. And you've got 3 main ways to hand over your money. You can go old school and buy physical, non-judicial stamp paper from an authorized vendor. You can use modern e-stamps, which a lot of states have now, and just pay online via RTGS or NEFT. Or you can use franking, which is where an authorized bank physically stamps your document with a special machine after you pay.
But listen closely, because signing and paying is just step one. Once you execute the deed and pay up on day one, a very strict legal clock starts ticking. You have exactly 4 months, no more, no less, to take that stamped document and officially register it at the sub-registrar office. If you miss that absolute 4-month deadline, your document can literally become legally invalid.
Which brings us to the million, or should I say the crore rupee question. After pouring your life savings into finding your absolute dream property, are you really going to risk losing it all over a missed 4-month deadline? So as we wrap up this explainer, ask yourself, is trying to dodge a bit of bureaucracy or save a few bucks on state taxes actually worth risking the legal ownership of your most valuable asset? Secure your shield, pay your duty, and always, always register on time.